on those things, and they're offering, if you just put up $1,000 here, you're going to get $500,000. Well, is that the way the world works? You know, it really. I mean, think about it. Is that the way the world really works? And common sense and reason, if it doesn't fit, boy, you better really, really read the information that you've been given on the investment. The next page, know the risks, know the characteristics of risk in investments. What I've done here is divide this into kind of three categories: bonds and stocks and the general guides. I'm not going to go over these things in specifics. I'll highlight a couple of things, but on the bond side, probably the most important one there is the top one, the high yield to maturity. It's one of the things in the bond calculations that sort of puts everything on the same wavelength, so that if Treasury bills are paying 3% today, and you've got an investment that's being offered at 9.8% in terms of a yield to maturity, that's yelling at you that it's got risk. Maybe that's a risk you're willing to take, but you ought to know and understand what that risk is. And that's one of the quickest ways to identify a high-risk portfolio or a high-risk investment, is look at what the yield to maturity is on the bond and compare it to what would be reasonably available in a risk-free Treasury bond. On the stock side, there are a number of things there. If you're looking at penny stocks or pink sheet stocks, for sure. And general guides, if there's poor liquidity or trading volume, or it's hard to find quotes, we have a tendency to think that, oh, it's okay, I can sell that. I bought this municipal bond. It's from one of the little municipalities in Arizona or whatever. And that's not high risk. That's pretty good. But if you need the funds and you go to sell it, you can't find anybody that maybe wants to buy it. And today, that's more important than it's ever been, because the Wall Street firms are not investing their capital to provide liquidity in the markets the way that they used to. It used to be any brokerage house would buy whatever you had, and they'd put it in their inventory, and they'd turn around and sell it to somebody else, and they'd have made money in the spread. And they're not doing that today. So they actually have to find a buyer on the other side of the trade. One thing I want to come back to on the bond side, the current example of high yield to maturity is Greece. Last week, when their bonds were downgraded, and then we had Portugal and Spain coming along, the interest rates on Greek bonds went straight up. They went vertical. And what that's telling you is that an investor may be on the other side and willing to buy those Greek bonds, but they're saying, hey, there's a lot of risk here. You're going to have to pay me a whole lot more, or I'm going to have the potential for a whole lot more before I will buy those bonds. If we turn to the next page then, very importantly, getting risk and reward right requires that we pay attention to the risk of loss in portfolios. And managing portfolio risk, there's a whole lot of stuff that can go into this. Most of us sort of have a knee-jerk and think, oh, well, all you have to do is diversify, and that's how you manage risk in portfolios. That's important, but is by no means the most important, by I would say a great distance. And really one of those that is the most important is the first one, or the margin of error, or margin of safety. Warren Buffett believes that it's probably the single most important principle of investing, and this was the idea of Benjamin Graham many years ago. And it means you only buy securities when the price that you pay for them is substantially below the value that you will receive. And the point is to provide protection for you from when the market in general misbehaves, and to provide protection from your own mistakes in valuation as well. A couple more comments here. Bring the income home. This is a safety and reinvestment factor. You want to get income in as quickly as possible and get it reinvested. It's really better for you to have control over that. If you leave dividends in the hands of a CEO, and the CEO is not paying dividends or not paying much of a dividend, what you've done is you've lowered the barrier for the CEO to make additional investments. And that CEO might invest in not only the top 10 ideas, but they're investing in their 75th best idea and their 76th best idea. And really, it's better for the market to come back and evaluate that. And there's a wonderful example of that, and I'm sure you could go on and on and on with these things. Microsoft in the late 80s and early 90s in particular was buying up a bunch of little companies that by the late 90s and the early part of 2000s, they had to write off their investments completely. And Microsoft wasn't paying a dividend at the time. They had all this cash. I got all this cash I got to use. I'm not paying a dividend because I'm too worried about paying taxes. And so I'm going to put it to work. And it wasn't just his money. It wasn't. It was everybody's money that was invested in Microsoft. Last one I'll comment on here is wait for the fat pitch. This is a Buffett phrase. Wall Street will provide an endless supply of securities and options for you. Wait, be patient, and select those that really represent a good opportunity to do well. I'm on the next page now. There are a lot of things that are very challenging about investing in today's markets and in this environment. And there's no doubt these are not your father's markets, as sort of a parallel phrase goes. The fundamentals of sound investing haven't changed. Benjamin Graham's margin of safety, that's an excellent requirement. The behavioral side of investing, human beings, we haven't changed. We still feel fear stronger than we feel greed or hope. And those have always been with us and will always play a role in driving the markets. But there are conditions in play today that accelerate the movement of risk across markets and that increase the risks of catastrophic outcomes. Derivatives have a destabilizing effect, and we have greater interconnectedness in markets than we have ever had. We've never seen the levels of debt that the U.S. has collectively. Governments, corporations, individuals, the U.S. is collectively in a lot of trouble with that. And the problem with debt is that it reduces our ability to respond to stresses. Our flexibility goes away. And what I think of is one of those great big aircraft carriers coming in the channel in San Diego. If something gets in their way, they have no place to turn. They don't have any flexibility as they're coming in. There is no doubt there is tremendous uncertainty. Through all of your own individual circumstances or the organizations that you work for, cognitive, emotional, financial, all of those things are different. They're going to come into play at all times. We strongly urge you to account for an environment of extraordinary uncertainty and assess your risk tolerance and investment decisions with that in mind. The potential for black swan events remain. The Huda-thunkets that we've seen over the course of the last few years, to me, have just been amazing to watch, and we just saw them time and time again, and things are still happening, and they can do very severe damage. Be very clear on how much you can lose permanently, and invest accordingly. If you're investing in a manner that you can't live with a permanent loss of a substantial portion of it, then you ought to rethink how you are investing. Go ahead. And remember that sometimes what matters, and this is, I think, this is a message that Tom has been sharing, and we got an interesting little reminder about that yesterday. Sometimes what matters is not so much how low the odds are that circumstances would turn quite negative. What matters more is what the consequences would be if that happens. What would the consequences be for you if we had another episode like what we went through in 2008, and then we didn't show signs of coming out of it? What would that mean for you?